channel. I'm Professor Don Bush. I've been teaching accounting for about 30 years, been a CPA for about that long, and I've got great ways to explain accounting. So today we are studying cash flow statements at the intermediate accounting level, and we're focusing on investing activities. This is the third example of investing activities. So I'm going to go kind of fast because we've already had two examples, although there's a couple of new complications here to study. Now, investing activities is not that hard to do, but you do have to be like a detective. So what's going on with this equipment? Well, equipment was purchased for $15,000 and some equipment was sold for $10,000. If you take $15,000, which was purchased, minus the $10,000, which was sold, that means the equipment account should increase by $5,000. 15 minus 10 is 5. So here you go. There's your change in the equipment account. So that explains it. But we're interested in the cash flow. So we're going to say here, Fred paid $2,000 cash. That's a negative cash flow. And Fred sold equipment for $3,000, so that's a positive cash flow. We're going to list these separately, actually, on the cash flow statement. Now, I also provided a journal entry right here, a journal entry to explain this second transaction, which is not a bad idea sometimes. So it's not a bad idea to look at this journal entry to figure out what is going on. So cash was received, $3,000. We're debiting accumulated depreciation because we're getting rid of this machine. The equipment is being credited for $10,000 because we're getting rid of the machine. And it all to make it all balance, we have to have a loss on the sale of equipment of $5,000. Now that loss on sale of equipment, that's going to go in the operating section of the cash flow statement. It's not going to go in investing, and today we are focusing on the investing activities. The only thing we're interested in today is the $3,000 cash that was received for the equipment. Now, here's another thing that I like to do for the investing section is I like to double check my work and make sure that I'm doing this right. And oftentimes what I'll do is I'll draw a T account. And here's a little T account that I drew for equipment. And here's all I do is I say, well, equipment started out at $15,000, ended up at $20,000. And can I reconcile how it got from 15 to 20? Well, here we go. Equipment was purchased for $15,000. Here it says so in number 1, and equipment that had a book value of $10,000 was sold during the year, and I got that from number 2 over here, right there. And so if you add up this little T account, 15 and 15 is 30, minus 10, you end up with 20, and this assures me that I'm taking into account everything that went on in the equipment account. So moving on here, coming down to accumulated depreciation on these balance sheets. Well, accumulated depreciation we want to ignore. 99 times out of 100, you want to totally ignore it. All we're interested in is depreciation expense, and we can usually get that off of the income statement. Now, sometimes your book authors will not tell you what the depreciation expense is, and sometimes they expect you to figure it out, and sometimes the only way you can figure it out is to look at the accumulated depreciation account, but that is not the case here, and it's not how you really do make cash flow statements when you're really doing them. So 99 times out of 100, just totally ignore accumulated depreciation. Buildings. At the beginning of the year, $80,000, end of the year, $80,000, no change at all. So we don't need to worry about it for the cash flow statement. And we have accumulated depreciation once again. Well, accumulated depreciation, ignore it. 99 times out of 100, ignore it. All we're interested in is depreciation expense, which goes in the operating section. Now, coming down here to land, it started out at $30,000. Ended up being $90,000, so land increased by $60,000. It appears that they bought some land, so let's see if that's the case. We have to look in the general ledger, look at journal entries, talk to people, look up documentation, whatever it takes to figure this out. And I've got some information right down here someplace. There it is. Here we go. Number 5 here. Purchased land. Paid $5,000 cash down payment and a mortgage payable of $55,000. So this is a cash flow statement. And even though they bought $60,000 worth of land, we're only interested in the $5,000 cash down payment. This is a cash flow statement. Now, years ago, when I first did cash flow statements, many years ago, we would have to write down the mortgages payable too, but we don't do that now. All we do is just the cash. So for land, it'll be that $5,000 cash. Patent. Now the patent started out at $8,000 and now it's $0, so that's a decrease of $8,000. So let's see what's going on with the patent. So here's some extra information on the patent right down here. So number 4, the patent was amortized, $2,000. And then the patent was sold for $15,000. Now this is a cash flow statement. We're interested in cash. So here's the journal entry to amortize the patent. So we have amortizing expense, $2,000, patent, $2,000, no cash there. Don't need to worry about it. But coming down to the sale of the patent, they sold the patent for $15,000. And here's how the credits shake out with that. So when we do our cash flow statement, we're interested in this $15,000 receipt of cash. Let's see what else we have going on. Investment in subsidiary was $80,000. At the end of the year, it's $85,000, increase of $5,000. So what's going on here? So this is the time where you have to look in the general ledger, look at journal entries, talk to people, and look up documentation, figure out what's going on. So here's a note that takes care of all that. Note number 3, the subsidiary was accounted for on the equity basis. And if you recall the equity basis, the owner of the subsidiary records income on the owner's income statement in the amount of the share of income that was earned, and deducts out any dividends that were received. So let's see if that happened. Let's see if that's what the case was. So Fred purchased additional subsidiary shares for $4,000 cash. I know it doesn't say $4,000 cash, but it was $4,000 cash. Just didn't have enough room here to write any more stuff. So that explains 4 out of the $5,000. So what else is going on? Fred's share of net income was $3,000. So that share of net income would increase the investment in subsidiary by $3,000. And Fred received subsidiary dividends of $2,000. Well, whenever the owner of the subsidiary receives dividends, that decreases the investment in subsidiary. So here's what's going on. Here's the $4,000 that of additional shares that were purchased, an increase of $3,000 here for the subsidiary net income, and deduct out $2,000 for the dividends. And if you do the math there, you get a change of $5,000. But what are we interested in regard to the cash flow statement? We're interested in the $4,000 cash paid. And we're not interested in the share of subsidiary income. That's a non-cash thing. And the subsidiary dividends received, we're not going to put that here in investing. It'll go up in operations. In fact, the share of subsidiary income and the dividends received are netted together. And it all goes up in the operating section of the cash flow statement. So ladies and gentlemen, that takes care of all the stuff here. So let's look at the actual cash flow statement. I'm going to split the screen so we can see what is going on down here in the cash flow statement. So folks, as you probably know by now, the cash flow statement's got 3 sections. It's got operating, it's got investing, and financing. And today we're focusing on investing. And today's been the most difficult day as far as investing goes. It's an easy section, but you have to go cautiously. You have to do your homework here. So purchase of equipment, $2,000. Where did that come from? That came from right up here. Here we go. There we are. Note number 1, Fred paid $2,000 cash. That $13,000 long-term note payable won't go on our cash flow statement. Sold equipment, received $3,000. So here we go. Sold equipment for $3,000 cash. There we are. Purchased land. And guess what, folks? Land, we're only including $5,000. They bought $60,000 worth of land. Let's see here. There it is. So they bought They paid $5,000 cash down payment. And there you go. That goes on the cash flow statement because that's a cash transaction. And the mortgage payable doesn't show up at all. So out of that $60,000 worth of land, we're only showing $5,000 of it. Investment in subsidiary, that's $4,000. If you recall, that is the amount of cash that was paid for those additional shares. The Fred's share of the subsidiary net income and Fred's share of the dividends doesn't go in investing. It goes up in operations. It's netted together. Sold the patent for $15,000. Here we go. Sold the patent for $15,000. There it is. So all you do is add this all up, and it looks like the cash provided and used by investing activities, $15,000 positive. So there you go. Now, just as a review, and I'll get rid of this split here, coming back down to this cash flow statement. Just as a review, cash flow statements have three categories. They've got cash provided used by operating activities. What you do there is either add net income, subtract net loss, add back non-cash expenses, add back losses, subtract out gains. You have to look at current assets. If current assets went up, the cash went down. If current assets went down, cash went up. So watch previous videos if that's confusing. And then we have to look at the current liabilities. If current liabilities go up, that means we're borrowing. Cash is increasing. If current liabilities go down, that means we're paying debt back. Cash is decreasing. So there's the operating section. And we just did the investing section. And here's the financing section. Financing includes two main categories: long-term debt and transactions with owners. So financing includes long-term borrowing, or paying down debt, and owner investments or owner withdrawals. So there you go, folks. There's the cash flow statement, the investing activities. Hope you learned a thing or two about the cash flow statement. And if you did, hit that like button, hit the subscribe button. Let me know that you liked the video. Until next time,